Introduction. In the aftermath of the 2008 financial crisis, regulators recognized the need for robust risk management and capital planning within the banking industry. To ensure the stability of the financial system and protect against future crises, the Comprehensive Capital Analysis and Review (CCAR) framework was established. CCAR has become a cornerstone of regulatory oversight, requiring banks to undergo rigorous stress testing to assess their capital adequacy and ability to withstand adverse economic conditions. In this article, we delve into the intricacies of CCAR analysis and its significance in maintaining a resilient banking sector. Understanding CCAR analysis. CCAR analysis is a comprehensive evaluation conducted by the Federal Reserve in the United States to assess the capital adequacy and risk management capabilities of large banks and financial institutions. The goal is to determine if these institutions have enough capital to survive severe economic downturns and continue lending to support the economy. CCAR evaluates both quantitative and qualitative aspects of a bank's capital planning process, focusing on the following key areas. Capital adequacy. CCAR examines a bank's capital position under various hypothetical stress scenarios. These scenarios simulate severe economic downturns, including recessions, market shocks, and other adverse conditions. The analysis assesses if the bank's capital reserves are sufficient to absorb losses and continue operating without posing systemic risks. Risk management. CCAR evaluates a bank's risk management practices and governance framework. This includes assessing the effectiveness of risk measurement models, stress testing methodologies, internal controls, and the overall risk culture within the institution. The analysis aims to identify any weaknesses or vulnerabilities that could undermine the bank's ability to manage risks effectively. Capital planning. CCAR scrutinizes the bank's capital planning process, including its ability to project capital needs, allocate resources, and adjust capital levels based on changing business conditions. Banks are required to submit detailed capital plans outlining how they would respond to adverse scenarios and maintain adequate capital ratios throughout the stress test period. Regulatory capital ratios. CCAR assesses whether banks meet minimum regulatory capital ratios, such as the Common Equity Tier 1 (CET1) capital ratio, as defined by Basel III regulations. These ratios serve as a measure of a bank's capital strength and ability to absorb losses. Banks failing to meet the regulatory capital requirements may face restrictions on capital distributions, such as dividends and share buybacks. Benefits and implications of CCAR analysis. Enhancing financial stability. CCAR analysis plays a vital role in promoting financial stability by ensuring that banks have sufficient capital to weather economic downturns. By subjecting banks to rigorous stress tests, regulators can identify vulnerabilities and enforce corrective actions to prevent potential threats to the financial system. Improved risk management. The CCAR process encourages banks to strengthen their risk management practices, including risk measurement, stress testing, and scenario analysis. This leads to a more comprehensive understanding of risks, better risk mitigation strategies, and an overall improvement in the bank's risk culture. Investor confidence. CCAR analysis enhances transparency and provides investors with insights into the financial health and resilience of banks. Banks that demonstrate strong capital planning and risk management capabilities are more likely to gain investor confidence and attract capital investment. Regulatory oversight and accountability. CCAR serves as a crucial regulatory tool, allowing authorities to closely monitor and supervise large banks. The process ensures that banks adhere to regulatory guidelines and are held accountable for maintaining adequate capital buffers and risk management practices. Conclusion. CCAR analysis is a pivotal component of the regulatory framework designed to ensure the stability and resilience of the banking sector. By subjecting banks to rigorous stress tests and evaluating their capital planning processes, CCAR helps safeguard against future financial crises. The analysis promotes sound risk